4 consecutive days of rising oil prices, U.S. military strikes on Iran, and a Middle East already on edge. When you put those three things together, markets don't stay calm. And right now, they're not. Here's where things stand. Oil prices have climbed for a fourth straight day, and the catalyst is about as serious as it gets. The United States has carried out strikes on Iran, triggering fears that the conflict could widen well beyond its current boundaries. That's the headline from Reuters, and it's the kind of news that sends energy markets into a different mode entirely. 4 days of consecutive gains in oil is not something that happens by accident. It reflects a sustained shift in how traders and investors are reading the geopolitical landscape. And right now, what they're reading is risk. To understand why U.S. strikes on Iran move oil prices, you need to understand what Iran means to global energy supply. Iran is one of the significant producers within OPEC, the Organization of the Petroleum Exporting Countries, and sits on some of the largest proven oil reserves in the world. But beyond its own production, Iran's geography is what makes markets especially nervous. The country borders the Strait of Hormuz, the narrow waterway through which roughly a fifth of the world's seaborne oil passes every single day. That's not a rounding error. That's tankers carrying supplies destined for Asia, Europe, and beyond, all moving through a choke point that is, in strategic terms, irreplaceable. There is no easy alternative route at that scale. So when tensions rise between the United States and Iran, the market's first instinct is to look at that strait and ask a very simple question. Could this close? Even the possibility, not the reality, just the possibility, is enough to move prices. Add to that the broader concern about regional escalation. The Middle East is already a patchwork of active conflicts and fragile ceasefires. A direct military exchange between the U.S. and Iran sits at the top of the risk ladder for energy markets, because Iran has both the motivation and the means to respond in ways that could affect oil infrastructure across the region, not just within its own borders. So how exactly does geopolitical tension like this translate into higher oil prices? Let's walk through the mechanics. Oil is a globally traded commodity priced in real time on futures markets. Traders are not just buying and selling oil that exists today. They're pricing in expectations about supply and demand weeks and months into the future. When a credible threat to supply emerges, those future prices move immediately, even before a single barrel is disrupted. It's the market's way of buying insurance. Now layer on top of that something called war risk premiums. Shipping companies and insurers don't move oil through contested waters for free. When conflict risk rises in a region, the cost of insuring tankers and cargo goes up. Those higher costs get baked into the price of moving oil, which in turn feeds into the broader price of the commodity itself. Disruptions of this kind tend to lift war risk premiums and freight costs as a matter of standard market mechanics. It's not speculation. It's risk pricing. There's also the OPEC dimension to consider. OPEC and its allies, the group sometimes called OPEC+, manage production levels with the goal of maintaining price stability. But their ability to offset a genuine supply disruption depends on how much spare capacity they actually have sitting ready to deploy. If markets believe that spare capacity is limited, or that member states close to the conflict zone could themselves be affected, the upward pressure on prices becomes more pronounced. Finally, there's sentiment and momentum. 4 straight days of gains suggest that the market isn't treating this as a one-day story. Each day that the conflict shows no sign of de-escalation is another day that the risk premium stays in the price. Momentum in commodity markets is real. Once a trend establishes itself around a credible narrative, it tends to persist until something changes that narrative. So what does this actually mean? For the energy market, for businesses, and for ordinary people? Let's start with the direct effect. Higher oil prices affect virtually everything that moves or is made. Fuel costs rise for airlines, shipping companies, trucking firms, and manufacturers. Those costs don't disappear. They get passed on, either through higher prices for goods and services or through compressed margins that eventually show up in earnings. For consumers, the most visible effect tends to be at the petrol pump, though the timing and magnitude of that pass-through varies by country and market structure. For businesses with significant energy exposure, think logistics, chemicals, aviation, sustained oil price increases above a certain level start to become a real planning problem. Hedging strategies can cushion the blow in the short term, but they're not a permanent shield. Beyond the direct cost impact, there's a broader economic signal here. Rising oil prices driven by geopolitical conflict are different in character from rising prices driven by strong demand. Demand-driven price increases often reflect a healthy economy. People are buying more, moving more, producing more. Supply shock price increases driven by conflict are stagflationary in nature. They push costs up while simultaneously introducing uncertainty that can suppress investment and growth. Central banks pay close attention to this distinction because it affects how they think about inflation and interest rate policy. If oil stays elevated for an extended period, it complicates the inflation picture in ways that are difficult to manage through conventional monetary tools. And then there's the geopolitical ripple effect. Countries that are heavily dependent on oil imports, and there are many of them, face immediate pressure on their trade balances and currency stability when prices spike. Emerging markets are particularly vulnerable because they often have less fiscal room to absorb energy subsidies or currency depreciation. A sustained conflict between the US and Iran doesn't stay contained in its economic consequences. It spreads through energy prices into economies around the world. So let's bring this into focus. What kind of event are we actually dealing with here? This is a geopolitical supply shock in its early, formative stage. The market is not reacting to an actual disruption in oil supply, at least not yet. It's reacting to the credible risk of one. That distinction matters. Markets can and do price in risks that never fully materialize. If the situation de-escalates, prices can retreat as quickly as they rose. But if the conflict widens, if it draws in other regional actors, if it threatens shipping lanes or production infrastructure, then what we're seeing now could be the beginning of something more sustained and more structurally significant. 4 consecutive days of gains suggests that the market is treating this as a developing story, not a resolved one. The smart approach, whether you're an investor, a business, or just someone trying to understand the world, is to watch the trajectory of the conflict itself. Oil prices right now are, in a very real sense, a live barometer of how serious the market believes this situation to be. And right now, that barometer is pointing upward. If you found this breakdown useful, subscribe to Investors Club Global for clear, calm analysis of the financial news that matters. Hit the like button if this helped you understand what's actually driving markets, and drop a comment below with any questions or topics you'd like us to cover next.